Hey guys, good afternoon and welcome to the CNBC-TV18 Mumbai newsroom. I'm Pavitra, with me is Ekta, and you're tuned into MF Corner. Now today we're going to talk about a space that has been very hot. The midcap index, even after the recent pullback, is up almost 30% for this year, and that has of course led to flows into this category of mutual funds only rising month after month. The latest August data, if you look at that, shows a big jump in inflows. That figure has risen to around 2,500 crore rupees. But what we wanted to understand on this episode is what mid-cap fund managers are doing now. Are they having a tough time deploying this kind of big rush of money that has come in? Are they increasing their cash positions? Would they even recommend this pocket when valuations have shot up so sharply? So, Ekta, to answer all of these questions, we have a mid-cap fund manager with us.
Hi, Pavitra. Yes, absolutely. We have a mid-cap fund manager this afternoon with us. We have with us Ankit Jain, who is a fund manager equity at Mirae Investment Managers India, to talk about the mid-cap space. Ankit, hi, welcome to the show. But let's start with the first question. You know, the mid-cap space has been buzzing, not only in the past few months, but, you know, this entire year. And we've seen a big jump in inflows to around 2,500 crores in August. Do you think equity flows will continue to be dominated by this part of the market?
Yeah, hi. Thank you for giving me this opportunity. Yes, you are right. If we look into mid-cap space, has been seeing very good inflows from around 1,500 crore average monthly last year. That has been inched up to around 1,800 odd crore by TD. And last month, as you rightly pointed out, it has touched almost all-time high at around 2,500 odd crore. So sometimes, asset allocation is clearly a function of good near-term returns, which has been the case in the mid-cap segment, which has seen almost 18% outperformance over large cap on YTD basis. So it is up almost at around 30%. But in inflows, good part is that even SIP book in the mid-cap segment has almost doubled to around 1,800 odd crore on monthly basis from around 900 odd crore couple of years back. So which typically speaks about that tenure of investors is also inching up over time, and which is clearly is a very, very good thing from the overall space point of view.
Okay, Ankit, thanks a lot for joining us. This is Pavitra. So, you know, last week we had that one single session where we saw the mid-cap index drop 3%. It scared everyone a little bit. Do you think that's just a one-off, or do you think that because of this kind of big run-up that we've seen, we could get a bigger correction as well here?
Yes, I mean, given, let's say, around 30% sort of a return in a short span of time, by TD last 7-8 months, minor correction is always healthy for the market, which might always be driven by some worry around maybe, let's say, crude oil price has really inched up from the lows. And also, expensive valuation is, into certain pockets. Having said that, I think overall earnings growth in the markets are still looking pretty good, pretty broad-based, with contribution across different sectors. And in that context, the market really, particularly mid-cap segment, looks a bit expensive from the near-term standpoint, with valuations premium being 15 to 25% versus historical average. But it looks still, I think, far more reasonable from the longer-term standpoint, more so when we see that earnings growth visibility.
Okay, all right. Well, the other aspect is, Ankit, you know, money is rushing into the mid-caps, but valuations have also risen. Do you think it's too much money, way too fast? And is it perhaps not a good time to be investing in a mid-cap fund just because of how expensive it might be?
If you look into mid-cap valuations on 1 year forward basis is at around 23x. And this is clearly expensive in historical context. When it used to be maybe at around 16, 17 odd x. So clearly, and more so, let's say if you look into valuation premium to large cap is also at this point of a time significantly higher at around 25%. So some part of it can be explained by good earnings growth outlook. However, fund flows also do play its own part to create exuberance into certain pockets of the market. So overall, if you look into clearly with good all-around improvement across macros, GDP growth, interest rate peaking out, current account deficit under control, I think, and plus on top of that, if you look into, there has been significant strengthening of micros, across different companies, you look into improvement in balance sheets, cash flows. So to that extent, I think earnings growth outlook is good. which might help in sustaining some of these premium valuations. But clearly, if you look into, let's say, last 10-year mid-cap return CAGR is at around 20% and out of which, I mean, almost half of it has come by way of valuation re-rating. So having done, I think, lot of valuation re-rating has already happened. So from here on, really return expectations to pan out, clearly earnings growth has to do all the heavy lifting. So to that extent, from near-term standpoint, we do clearly prefer large caps over mid caps because we do see more margin of safety out there. But clearly, I think with 5 years sort of a time horizon, mid cap do offer higher earnings growth potential, and to that extent, we continue to remain positive there from that time frame in mind.
Okay, I think that's fair warning that, if you are looking at a short period, even a 1 year kind of period, you're perhaps better off sticking with the large caps just for that safety over a mid caps. But, for a longer period, of course, this could be a very beneficial pocket. Ankit, you were just mentioning the valuations. Currently, the mid-cap index is at around 23 times, and historically, it has been at around 16 to 17 times. At what point would you begin to worry? Would you say that now is the time to just completely stop looking at mid-caps because there's too much froth? Currently, it's at 23%. What level does it have to get for you to actually be too worried?
Yeah, no, so at an aggregate level, clearly valuations are expensive, but at any given point of a time, there will always be pockets where, there will be decent sort of opportunity, balance, risk, reward, margin of safety. So to that extent, that is how we are playing. So at this point, if you look into sectors like, let's say, financials, pharmaceutical, maybe, and consumer discretionary, I think some of these sectors do offer, I think it's still reasonable margin of safety with decent earnings growth visibility. But having said that, if you look into certain pockets like which has seen, I think quite a bit of a run up, maybe capital goods, defense, some of these themes are looking a bit more expensive to us at this point of a time. So having said that, at an aggregate index level, clearly valuations looks expensive, but within that there are pockets of opportunity, and that is how we are incrementally trying to deploy.
Okay, fair enough. But Ankit, would you recommend maybe to your clients a multi-cap or a flexi-cap fund over a mid-cap fund right now?
Yes, absolutely. If you look into from, let's say, near-term 1 year standpoint, maybe flexi-cap as a category typically do have larger proportion of large cap. And to that extent, as I mentioned, that maybe from 1 year time horizon standpoint, maybe large cap is a better place. So clearly, I think flexi-cap as a category, which typically do have 60-70% large cap proportion, is a relatively better bet. But having said that, as I mentioned, that sheerly from the earnings growth potential standpoint, mid-cap continues to remain a sweet spot in the market, and that is how one should approach with maybe 5 years sort of a time horizon.
All right, that's good advice for anyone who's looking to invest. But let's now talk about the fund manager's perspective. Ankit, are you as a fund manager having a tough time deploying this sudden rush of money? Because, I was talking to some small cap fund managers earlier. I'm sure, a lot of them have stopped lump sum investments as well, just because they're saying we don't know where to put this kind of money. Is that happening in the mid-cap space as well?
Yes, if you look into higher inflow in particular market cap segment as a percentage of AUM, to clearly impact deployment. More so in mid-cap space, given one has to invest within the same set of universe of 150 companies, right? But despite of increase in free float market cap over time, mutual fund ownership as a percentage of free float market cap has also gone up. So it is now almost at around 30% versus maybe 20, 21, 22% 2-3 years back. So to that extent, clearly, sometimes ability to deploy in a right manner, more so at a higher scale, becomes a bit of a challenge. But having said that, clearly, if you look into at an industry level, yes, maybe mid-cap funds cash levels might have gone up. But we always, used to have relatively lower sort of a cash levels in the fund. And as of now, also, we are at around 3-4% of the AUM. Maybe in the past might used to be at around 2% of the AUM.
Okay, that is interesting to know. Ankit, we have lots more questions, but for now, we have to take a mandatory break on the show. We'll be back in just 2 minutes to understand more of what you are doing with this big rush of money.